I'm Gregory Frank, and this is Everresi Media. Welcome. Things are moving fast in Washington and across our industry. Just this week, the House passed a major housing package without any amendments regarding SFR. At the same time, the Senate's considering an amendment that could impact institutional owners, and we're seeing increased activity at the state and local levels, all driven by the Trump administration's executive order, adding in the pending exemption for build to rent and establishing who is an institutional owner. It's clear this is a defining moment for our sector. We're fortunate to be led by our moderator, Kimberly Byrum, managing principal Zonda, who continues to bring clarity and credibility to the most complex issues facing housing. She's joined today by an exceptional group of industry leaders: David Howard, principal and founder at the REHD Group, and one of our industry's most respected voices in policy and advocacy, John Isakson, CEO of Arc Homes for Rent, Matthew Putterman, Managing Director at JLL, and Ed Steffelin, Managing Director at George Smith Partners. With so much at stake and so much evolving in real time, there's a lot to unpack. Kimberly, thank you for stepping up and leading this moment. We're grateful you're here today.
Thank you for having me. So glad to be here. And I'm excited about the panel that you put together. Just kind of drilling down a little bit more. I'm excited. John's kind of bringing, in my mind, that owner operator perspective. Then we have Matthew on the investment sales side. He's going to bring clarity there. David Howard, of course, being the policy expert and is in the room talking on our behalf. And then Ed, a great friend of Zonda, will be rounding it out, talking about capital. Want to jump right in and start talking about this pending legislation. And David, the first question goes to you. What is the industry's reaction to this executive order and this February 19th deadline?
Well, I think the industry in many ways is still trying to figure out what lies ahead. The executive order, as we all know, came out on January the 19th in the afternoon. And, it was interesting. The first time I read through it, I thought, oh my gosh, this is going to be really bad. Each subsequent time I read through it, it seemed to be less bad. It never got to a point where I would consider it good. I don't want to be mistaken on that front, but it became a little less bad. And partly that was because it's an unusual executive order in the way that it's written. Most executive orders, I've been involved with a number of these over the years, most executive orders are fairly specific because when you think about it, an executive order is something that the president wants to accomplish. So they want to tell you what they want to do. They want to tell you how they want to do it. This executive order really didn't do that. As a matter of fact, it almost did the opposite. The president came out with a tweet on January the 7th saying he was going to ban institutions from buying single-family homes. Well, the executive order that came out subsequent to that really doesn't do that. It makes the process more difficult. It closes the door on doing business with the federal government. It does a number of things, but it doesn't really ban institutions from purchasing single-family homes. And we can talk a little bit more about that. And again, it's not a very clear and concise document. So all that to be said, I think the industry is still trying to figure out what this thing is and how we move forward. I think there's a legislative path that this order will follow. We know that the president wants the executive order codified in legislation, which means he wants Congress to create a bill, introduce the bill, put it into law. A couple of different ways that can happen. We can talk more about that. One of them is the ban language will be folded into an existing housing bill. Or the other path is the executive order will be codified in a standalone bill. The ban will come out as its own piece of legislation. And those are the two ways I think this is going to move forward. How that happens, when that happens, a lot of that is still very much unknown.
Real quick follow-up on that. So what's the benefit of a standalone versus folding it in with other legislation?
Well, it depends on your perspective. I think if the ban is folded into an existing piece of legislation, it's going to be more difficult for industry to overcome that. And that's because there are two legislative vehicles. There are two bills in existence currently that would be natural places for the ban to go. There's a bill in the Senate, the Road to Housing bill, sponsored by Tim Scott, chairman of the Senate Banking Committee, which passed the Senate back in October. And then there's a bill in the House, sponsored by French Hill, who's the chairman of the House Financial Services Committee, Housing in the 21st Century, which actually passed just this week, passed overwhelmingly. These are big, broad, sweeping housing bills. And so either can be amended to accommodate language to ban institutions from purchasing homes. The question is, will they? The problem for industry, should that happen, should the ban language make its way into one of these bills, is because these bills have so much momentum behind them, it's going to be difficult for legislators, many of whom have already come out in support of these bills. It's going to be difficult for legislators to pull back that support and vote against bills. So again, I think if either of these bills are amended to accommodate the ban language, I think it's going to be difficult to keep the ban from becoming law. I think, on the other hand, if the ban comes out in its own legislation, standalone as a standalone bill, it will be easier for policymakers to vote against it. I know from having had a number of conversations on the Hill over the past couple of weeks, there actually is opposition to an outright ban on institutional purchases. And because of how the House, for example, is divided, number of Republicans versus number of Democrats, you only need a handful or so Republicans, Democrats to vote away from their party for this bill to be defeated. So again, I think if this ban comes out as standalone legislation, I think it's going to be easier for industry to defeat the bill. If the ban is folded into one of these existing pieces of legislation, I think we've got a harder road in front of us.
That's great insight. Thank you so much. So, John, turning to you, in considering this ban, is that impacting your plans for development and your pipeline?
Well, it's impacting us in the sense that it has made capital more difficult. We certainly have had more questions from investors and lenders who are looking at the confusion and the lack of clarity in the market when they're making their decisions to move forward. And that's an industry-wide problem inside of BTR and SFR. From an operational standpoint, no, nothing in the executive order or in the proposed legislation is backward looking. So all the deals that we have in place today, we have every confidence that we'll be able to move forward, complete them, lease them up, operate them. So from an operating standpoint, no, but from a forward looking standpoint, yes, this is causing a lot of issues.
Great insight. Matthew, how is JLL modifying their platforms to respond?
Yeah, I think it takes a little bit of definitional understanding, some of which we don't yet have, to distinguish build to rent in its many different forms and formats against more traditional scattered SFR. And what the administration has come out and said in a few different ways, and the industry is trying to work with legislators and policymakers to go figure this out, is where do we distinguish between the various kinds of build for rent and scattered SFR? And if you look at JLL brokerage practice nationally across sales and capital raising, both debt and equity, we don't focus just solely in the scattered SFR space, nor solely in the build for rent space. And because of that, we've got experience in all of those sectors. And I tell you, we have also been a part of working with single family rental operators, getting more into the various kinds of build for rent over the years. So have historically not focused solely on just one at the expense of the other. For that reason, we tend to follow where our clients are going and provide the best guidance to them at any given point in time on where the capital trends are flowing, and how it relates to some of the other investable housing asset classes.
Got it. So, Ed, want to shift over to capital. John mentioned the word uncertainty. How is uncertainty impacting the capital side of the house?
Well, nobody loves noise, right? I mean, when you're, trying to put money out, and look, I think the environment for raising capital, at least on the equity side, on JV equity, is a little bit hard anyway. And then you add some noise around it certainly doesn't help. Nobody likes to wake up to a tweet and be like, oh no, right? And the policy change, that's not good. I do think there's still people putting out money. It hasn't quashed the industry, especially with the build to rent exemption. I think one of the interesting things is a lot of the scattered site purchasers use securitization to fund themselves, right? The former Tricons, before it was Blackstone and others. So that market might be a little bit more on pause, whereas, we focus mostly on purpose-built build trend communities. So I was very happy to see that exemption in there. But I think, look, and obviously for a long time, there was like a debate about single plat or individually platted build trend communities. I think, at this point, you'd feel a little bit better if you had a single plat. So it really is multifamily at the end of the day. And so I think those are some considerations for people as well.
So, real quick, want to follow up on something that you said with Matthew. Matthew, what is the investor appetite right now for the different call it flavors of BTR? What are you seeing out there?
Sure. So Ed hit on it really perfectly. When you look at an individually platted home community versus a single large tax parcel, that certainly eliminates any of the non-real estate risk, right? People go invest in real estate deals and they want to be taking real estate risk. They're not looking to also take legislative or municipal or any other kinds of additional risk. If they're developing, they're obviously taking on, construction risk as well, but I'd classify that within the real estate risk. So as you look at a single tax parcel product, that is largely the same risk that it was at the end of last year and will be going forward. And then as you introduce the various levels of different kinds of BTR, whether it's a forward purchase or whether you own the land and you're engaging a home builder as a fee builder, there's many different flavors of this that could be, to some investors, construed as potentially risk beyond just the real estate level. In our minds, those for build to rent communities are incredibly muted, especially as the administration has become a little bit more clear, but not yet perfectly clear on their intents around individually platted, purpose-built rental communities. And I believe, and I'd be interested in David's perspective, as we get more clarity there, that should mitigate most of those concerns. And at the end of the day, we are creating more housing, and through more housing, you do have more options for renters and buyers. And it's a simple supply demand equation. And with the recent housing bill that was passed this week, there are some things that address the root cause of the issue, which is the supply issue.
Very good. Very good. Well, I want to shift the conversation a little bit and just kind of drill down, Matthew, again, coming to you on the defining all of the purpose-built sectors there. Can you give us a little bit of just definitions and also some of just the zoning headwinds that you're seeing in the space?
Yep. If I heard the parts of the question, how do we define true purpose-built BTR and where challenges might exist?
Mm-hmm.
We really do start first and foremost on, is it a single platted site or is it individually platted homes? There are many things that go along with the individually platted home sites that you might not see in a more conventional multifamily style, call it horizontal multifamily or cottage multifamily. You tend to see those developed and operate and have similar considerations to multifamily. And then as you get into individually platted home communities, we've seen every flavor under the sun of buying on a forward basis from a home builder in its own distinct part of a community. Many of our clients have gone out and purchased developable lots themselves and engaged their own vertical GC. Many times can be a for sale home builder who has those building efficiencies. So as we look at it, those build ready lots tend to be pretty flexible in terms of home builders being able to execute the vertical strategy there. And then on the singular tax parcel product, that being pretty much shovel ready and approved for rentals already. So haven't seen much in the markets where we operate. And I think there's also some adverse selection there away from more highly restrictive places like California or New York or other places where there are more limits to building generally, whether it's for sale or for rent. So, being down here in the South, just a little bit less red tape to get through, where there also tends to be more housing supply and a little bit more affordability.
Right. So, David, do you think that this exemption is going to help eliminate or reduce some of the friction that we see on the development side with municipalities?
Well, again, there's a lot that we don't know about the exemption. All that we do know is there was an acknowledgement by the White House in their executive order that build to rent has an important role to play in the business of providing housing supply. And that's a really important point. The fact that, again, the president came out and talked about banning institutions and all that implies, and yet included a paragraph in the executive order that created an exemption. Now, the way that it was worded in the executive order was the exemption would be narrowly tailored. And that's really all that it said. And so we need to wait and find out. We need more clarity on what this exemption actually will entail. I actually think, contrary to the fact that the wording implies it's going to be a very narrow exemption, I actually think there's a chance it's going to be broader in nature. Because again, I think the president has been very clear and correct in his claims that the problems facing the housing market really have to do with a lack of supply. We just aren't building enough. And so to be public about that, as the president has, and not support something like build to rent that actually brings more housing online seems inconsistent. So for that reason and others, I actually think that build to rent's going to come out of this as a big winner. I think it's going to come out in really good shape. We need to again wait and see how that exemption actually reads. There's a lot that's going to go into it. There's a lot that needs to be considered. For example, are we talking about newly constructed communities? Are we talking whether they're single plat or not? Are we talking about individual scattered site build to rent? What is the permanence of that exemption? I believe, for example, that any exemption should be a lifetime exemption. Somebody who, if you build a new home community for rent, as the purchaser of that community, obviously you need to know that you're exempt from any ban that exists. But you also need to know that you're going to be able to turn around and sell that community 7 to 10 years down the road, or whatever your exit timeline is. And whoever comes in to buy that community 7 or 10 years down the road, they need to know that they're in turn going to be able to sell that community 7 to 10 years from then, or whatever their timeline is. So any kind of exemption is going, in my view, is going to need to be permanent in nature. We need to have a lifetime exemption. So that's just one of the considerations that is going to need to go into how this exemption is written. And the question is, are the people who are writing this exemption, do they really understand the market? Do they know what they're doing? Do they know need to be considered in putting this exemption together?
Great, great. So, John, I think I already know the answer to this, but what product is the most accepted by the municipalities of the BTR types of offerings?
Well, I think, that's going to vary market by market, but what is well accepted in Florida might be different than what's well accepted in Georgia. And even within those states, what you would build or what you would look to build in Metro Atlanta versus what you might build in, Savannah or Rome or somewhere else, that can be different. I can tell you that generally speaking, what municipalities are looking for and what we're building is they want to see a product that looks like a high quality home. And whether it's for rent or whether it's for purchase, they want to see a high quality home. They want to see a use of materials and a use of architecture that's unique, that's thoughtful, that's well designed, that's timeless. And they don't want something that looks cheap or poorly built. So you get a lot of requests for brick, you get a lot of requests for a hardy plank siding, you get a lot of requests for gable roofs. I mean, they want to see something that's where they think people would want to live or where they would want to live. So I think, townhomes versus detached, there's not a lot of resistance one way or the other to those. There's certainly a place in the market for both of those. I think it's much more the presentation, the curb appeal, if you will, and the use of materials, especially on the exterior, that really
Very,
drive a lot of the questions that we get, both from the neighbors and from municipalities.
very good. So, Ed, from a pricing standpoint, how does entitlement risk impact that part of the equation?
Yeah, I think, most of the capital we would be raising, entitlement risk would be gone. But I think there's, from a certain municipality of delays and, places that you might run into more challenges on timing of inspections and maybe some pushback on the rental community would have a little effect. But I think in general, most of the stuff we're doing is going to have their entitlements in place. We have seen delays on building permits, inspections, those kind of items. I think that's less of an issue these days with, obviously volumes are coming down. So we don't see a huge effect on that.
So, I want to switch gears again and talk a little bit, 30,000 feet at the BTR segment and how it complements a housing strategy of any municipality or any community. So, John, can you explain at that level, in your mind, how BTR complements the housing supply and what do residents really like about the product?
Sure, that's a great question. I have kids from 20 to 34, so I certainly see a lot of these choices playing out in real time and in real life. And what's really happened is demographic preferences have changed over the last 20 years. And ever since the GFC, there is less of a sense of priority for homeownership, which is not to say that people don't want to own a home. They do, but they're renting for longer by choice. They want to be more flexible with their job. They want to be more flexible with their geography. They're putting off the major life decisions of buying a home, of getting married, of starting a family. And so what BTR does is it gives them the opportunity to have a homeownership experience, if you will, but maintain the profile of being a renter. And so they want the extra bedroom. They want the garage for the nicer car because they've gotten the promotion. They want the yard for the pet, and they want a front door, and they really like the fact that they don't have somebody above them or below them. They just might have somebody on either side. It just creates a little bit more sense of privacy, a little bit more sense of home and community. And for us as builders, what we try very hard to do is create a community that fits well into whatever market we're building in. Going back to the curb appeal and the use of materials, for us and for me, when I talk to our residents and when I look at the kind of polls and reviews that we do, they want to feel like it's a home, quote unquote, even if they don't own it. And so to me, BTR is filling a gap in the market that's been created over the last 15 or 20 years. Whether interest rates go up or go down, I think it's far more preferences and choices that people are making, and it's less economic. Certainly economics has something to do with it, but if interest rates went to 3% tomorrow again, I don't think the BTR or the SFR market would collapse. It might shrink a little bit, but I don't think it would collapse because I think our residents are still doing this because they want to, not because they have to.
So, Matthew, from a national perspective, for years, the multifamily world were gateway cities. And then, when you switch over into this BTR segment and you're going into outer suburban, almost rural, new growth markets like the Savannahs of the world that maybe institutional capital has not played in. How do you get people comfortable with the BTR type markets? And are there, what's the appetite across, different markets from potential buyers?
Yeah, I'd say buyers will gravitate towards where there is demand. And what we have seen is that there is demand for this product across the country. We're recently closed a transaction for a BTR community in the state of New York. That is not on your top list of places where you thought you'd see a BTR community. But the fact of the matter is, home ownership is not attainable for everyone. It's not desirable for everyone, as John mentioned. I mean, I'm on my third week in a row of repeat trips to Home Depot to fix things around the house. Not everyone gets excited about that on their Saturday afternoon. So, as home ownership goes, it also comes with the burdens of being a homeowner, not to mention the costs. And that lock and leave lifestyle is attractive to some people. And you look across different demographics if you just focus on age solely and then can go from there, single or married or with kids or with pets. BTR offers the institutional rentership experience of an apartment, which so many of these residents are used to. And if they're delaying home ownership for a period of time, or if they're just, maybe not even engaged in the idea of home ownership, they've gone from this first-rate multifamily experience and expect the same in their home renter experience. And maybe historically that option wasn't there and they were relegated to a privately owned home rental in their respective town. Now they've got a more professionalized experience, either on an individual one-by-one scattered basis, or for the subject matter here, inside of a rental community. And then as they get into that rental community, if they end up relocating to different cities, they've got the opportunity, if they had a positive experience with John in one location, they can go rent from him in the next city that is their destination. So it's really responded to the demographics, and those trends have been underway for a while.
So, Ed, Capital has a whole checklist of underwriting things that
Yes.
they go through in their diligence. Talk about how resident quality of BTR, that renter profile, how does that impact investor confidence?
Well, I think, one of the things that we don't talk about often is there's only so many people who can write a bigger check, right? Even if you want that lifestyle, these are, if you look at them even on a per square foot rental, but they're bigger generally. And so that's a bigger check. So you have to qualify. I would say all else being equal today, people would prefer to have stronger, renter, credit metrics. And we have seen a lot of fraud in the last year or so. But I think, what attracts people to these higher income, higher FICO, better communities, if you will, especially today, right? I mean, I think there's a lot of concern about the labor market, what AI is going to do to the labor market, catering to that little bit higher income demographic, and I think Matthew referred to it, or John, the renter by choice, not the renter by, necessity, is a great place to be in this kind of uncertain economic environment.
So, David, is all of this renter quality, demographics, product type, how is this being recognized in policy on the renter
Well,
quality side?
so there's growing. I mentioned it before in the context of the executive order. There's growing acceptance and recognition that build to rent has an important role to play, and we see that in policy circles, whether here in Washington D.C. at the federal level or increasingly at the state level as well. There are a number of bills at the state level, and John knows this well. Because we see a lot of this happening in Georgia, unfortunately. There are a lot of bills at the state level that target institutional ownership or acquisition practices, that sort of thing. But many of them include an exemption for build to rent. Not all of them, but certainly an increasing number of them. And so, again, what that says to me is there is growing acceptance of the role that BTR plays. The challenge is the market is still relatively small. And Kimberly, you and Matthew probably have data on this, but how many homes are built for rent every year? 40, 50, 60,000? To the extent that continues to grow, I think that's very positive, but that's still only,
Dropping.
10, 15% of the overall number of new homes that are built in this country every year. So we're just at a point where we need to keep, we need to keep getting in front of policymakers, legislators. We need to keep telling them the story. We need to keep telling them about what we're hearing on the call today from John and Ed and Matthew about why build to rent makes sense, because it does. And there are a lot of really good reasons why in these bills, whether they're in DC or at the state level, very good reasons why build to rent should be exempted and build to rent should be a part of the new housing story.
Got it. Got it. So we're going to switch now and talk a little bit about Ed's background and, of course, Matthew as well on the financial feasibility. And I have said a couple of times already this year, and maybe it's just beginning of the year exuberance, but I am definitely seeing green shoots. Those are my two new favorite words in many markets and many, at least developer optimism in terms of underwriting. So, Ed, what are you seeing in term when deals are coming across your desk? And I hope they are. What's working? What's that yield on cost? Where are you seeing construction costs? Give us some numbers.
Yeah, absolutely. We're not seeing a lot of green shoots here in Manhattan. We're seeing a lot of snow still.
Oh,
So
no.
green shoot sounds wonderful. Yeah, I mean, I think we're seeing a lot of deals, and as we mentioned, the joint venture equity space has been challenged, and I think part of that challenge was the supply wave that hit, obviously, and you know better than anybody, Kimberly, the markets that had an oversupply, and institutions really like to. The kind of standard underwriting is untrended based on today's rents, and well, if you go out, you're going to see a lot of incentives, right? You're going to see 2 months free. You're going to see gift cards. You're going to see. And it's difficult to get things to underwrite when you're taking a couple months of free rent plus a gift card and still not leasing super fast. So I would say the challenge with the market, and look, there are people putting out equity. There are a couple big groups in particular, I think, that are still very active. But for the marginal group, I think that is a challenge, is trying to underwrite. And I think, we have a lot of sponsors and clients, but look, there's going to be no supply in the future.
Mm-hmm.
But it's very difficult for people to underwrite forward-looking rents, and that's just the nature of the beast we deal with. And I think that's going to continue to change as we've seen absorption kind of eat through some of the supply issues. But until that really stabilizes, I think it's going to be deal by deal. And so in terms of metrics, 6.5 to 7% return on cost, depending on the market. I would say 7% for, maybe more suburban. I don't want to use the term generic product, but for kind of a maybe more infill, you can get that more 6.5% return on cost. Leverage, most institutions don't want to go behind high leverage, right? There's a lot of debt in the market today that can get you 80, 85%, but institutional capital doesn't want to be the joint venture equity beneath that. That's just not where they want to be. So a typical institutional deal would be 60 to 65% construction debt.
Mm-hmm.
And then on the exit risk, I think that is, as David mentioned, where this noise is a little bit more appropriate, right? You look at the stocks of Invitation Homes, American Homes for Rent, other real estate companies today that are all getting hit by this AI fear. It's a takeout. And so that goes to your market. Are you in a smaller market where there's going to be liquidity? and who are those buyers. And some of this noise around regulation might limit that universe. Who can buy this asset and create positive leverage? I think that is going to continue to be a bit of an issue here as people underwrite the takeout and how they, who buys the asset at what price with what leverage.
Right. So, John, I'm assuming you're still underwriting deals and chasing deals, at least looking, you've got a team, I'm sure, dedicated to that. How have you modified your underwriting? And I know those change all the time, but what are you seeing right now, and what are you underwriting to, especially as it relates to exit cap? And I definitely want to get Matthew's opinion on this. But not a lot of markets have seen a lot of trades, and so how do you even kind of forecast that?
Sure, that's a good question. For us on the capital side, we have a committed private equity fund, so our equity is in place, and fortunately, I mean, to Ed's comments, we don't really have to deal with that. From a debt standpoint, we've definitely seen terms improve over the last 12 months. More market participants, both the private market participants, but as well as Freddie Mac and Fannie Mae, who have become a little more familiar with BTR and been more willing to lend on it, looking at it when it is, more like multifamily, which absolutely we think it is. In terms of underwriting, we've gotten a little more conservative on rental rate growth as market rents have grown more slowly than people have anticipated over the last couple of years. We've been a little more circumspect on smaller and mid-size markets, focusing a little more on the sort of bellwether markets in the southeast, and we'll sprinkle in a couple of slightly smaller markets, but we've moved away from the secondary and tertiary markets and really feel like a quality institutional portfolio needs to be located in quality institutional markets. Your question about exit cap, it's so hard in this moment to figure out what that is today, never mind what it's going to be in 5 to 7 years. And it is market dependent. I mean, we'll go up on an exit cap rate in the smaller to mid-sized market than we will in some of the larger markets. But I would say it's anywhere from, for us, we look at exit caps anywhere from 5 to 5.5, just kind of depending. We certainly hope we're going to do better than that, but hope's not really a plan. So we're being a little more conservative. And we have the luxury of having committed capital, and so there's no question we're being picky in this.
Are you underwriting bigger deals to kind of spread those construction costs out among more homes, or is there any kind of, model adjustments there or deal?
No, kind of the opposite. You know, more isn't always better. From an operational standpoint, although BTR is multifamily, when you look at a multifamily deal, you have studios ones, twos, and threes. And so you can appeal to a very wide segment of the market. At BTR, we're really only threes, maybe a few fours. So the market segment that you appeal to is much smaller. So your absorption is going to be slower. And one of the biggest problems in new construction and lease up is once you get to that 1 year mark of lease up, if you still have units left over, well, now you're fighting the renewal battle as well as the new lease battle. So we really prefer, I mean, we say that our target is 100 to 250 units, but the sweet spot is really 150 to 200 units. And I would say if I had my druthers, it'd be 150 to 175. That's the mark where operationally, from a staffing perspective, you are your most efficient and also your most productive. And from a leasing and lease up standpoint, it's still very achievable within a 12 to 18 month time frame. So you're not fighting that backdoor renewal pressure too much on the lease up. Did that answer your question?
Yes, yes. So Matthew, where are you seeing institutions being most cautious in the underwrite?
Everything that Ed mentioned, things that folks are keeping in mind, the only primary addition that I would have is total cost basis relative to where deals are trading. And I forget if it was Ed or John that mentioned, but there's not much in the way of trades in the market right now in the BTR space. We've been fortunate to move a few transactions here to start the year, but unlike in the multifamily space where trade data is abundant, in the BTR space, you have fewer trades per market, and there may not even be perfect overlap in terms of product type to product type. So a detached home trade in one part of Atlanta is a data point, but maybe not the most helpful for a townhome trade data point or a townhome construction cost data point in another part of Atlanta. So a healthy bit of triangulation that investors need to do, which they are willing to do and have done. But if you look at the cost basis, costs have certainly risen in excess of where some of these builders first constructed the deals. But investors want to feel like if there's a better opportunity to buy at a supremely attractive discount to today's replacement cost, that's interesting to them. They're also cognizant that construction costs will continue to rise. To Ed's point earlier, we're going to hit a supply cliff where that'll create some opportunities for rents. As John said, hope's not a business plan, but there is an understanding that as supply demand remains steady or grows in some of these larger markets, you will create some value there. Folks just want to feel comfortable that today's cost basis is somewhere relative to where they could go buy, understanding that they're going to be building something brand new and not having to sign leases for 12, 18 plus months.
Right. On the real quick on the concession side, Ed, Matthew, John, for sure, are people assuming that 20% off is going to burn off, or are they underwriting the difference between 20 and 1 month, or where are people landing on concessions in their underwrites?
I want to know what John has to say.
Yeah, so I'm waiting to hear.
Sorry.
I figured as much. So again, very market dependent. I think Matthew made a good point. Just because you're looking at a deal in the Atlanta market doesn't mean that every other deal in the Atlanta market is relevant. It's really sub-market specific, site specific. Generally speaking, concessions are prevalent throughout our sort of Sunbelt markets that we see with some degree of variability. I mean, we certainly see everything as low as kind of 0 to 4 weeks in some stronger markets where that supply overhang is really starting to get absorbed and burn off, up to 6 or 8 weeks in some of those markets where there's still a supply overhang and you can still feel that it's going to last at least for the first half of this year. I think that's probably, at least for the markets that we're in, I think that's probably the range, is sort of that 0, which is fairly rare, to 8 weeks, which is unusual but not rare. I think 4 to 6 weeks is the sweet spot today. And yes, we are planning for that to burn off, albeit a little bit more slowly than we had anticipated probably a year ago. We're hanging on to that. Again, we're being a little more conservative in our underwriting, being a little bit pickier about the deals that we're going after in this environment where there is so much uncertainty, both from a market and economic standpoint as well as a regulatory standpoint. So we're definitely being a little more.
So, kind of rounding out this section, you to talk a little bit about how policy may factor into the capital structure, the policy risk.
Well, I think, obviously the word of the day is uncertainty. And that's a problem from A to Z in this industry and candidly any other industry. It's interesting. I've had some conversations with folks about this executive order, and to some extent, there has been talk in Washington, D.C. and state capitals across the country for a number of years about regulating this industry. And I can have an argument with you all day long about the pros and cons of doing that. But what that has done is it has brought some level of uncertainty to the business of single-family rental housing. And that uncertainty has been with us for a number of years. And I think what we're seeing now is kind of the culmination of what has been building for the past several years. And some have made the case, and to some degree I see this, that is, if there's legislation that regulates the industry in a way that is smart and makes sense and doesn't prohibit all of the good things from happening that have been happening, maybe within the context of these guardrails, the industry can move forward and do what it's good at doing. It's similar to what's happening now in crypto, right? The crypto industry is saying, look, come up with some regulations that are smart, that make sense, that enable the industry to take advantage of growth opportunities, but let us know what those guardrails are so that we can do those things. I mean, to some degree, maybe that's what's happening within single family rental. Maybe, nobody wants intrusiveness. Nobody wants guardrails that impugn on the industry. But again, if there is legislation that makes sense, that is smart, that allows companies to be innovative and do the kinds of things they're good at doing. Maybe that's what's needed so that we can all move forward and kind of get out of this mess, because this overhang, this uncertainty is really not good for anyone. Now, Kimberly, if you wanted to have a different conversation, I could also talk to you about how regulation is not needed in this industry. But again, I think that's a different conversation. But my point is, what we need is some certainty, whether that is with the legislation or pending legislation that's out there, whether that's with some of the regulatory initiatives that we see at the state level. We just need some certainty about what's coming next.
Right.
And we need to have a voice in how that regulation and legislation is developed.
Well, it's great, I think, for you, especially coming together. I've always said that apartment developer or apartment owners and home builders are kind of like high school or junior high girls and boys at a dance. They're all standing on each their side of the gym, and they all want to dance, but no one wants to make a move. And I do believe that this BTR space, really straddles the line of being like a home, but being a rental. There's a lot of uncertainty in it. And before, when it was moms and pops and individual investors, and now that we've really come in for lots of reasons, it kind of bridges the gap there, and there's a lot of uncertainty. So we appreciate you, David, in particular, for being so engaged in that process. So finally, wrapping it up, but David, want to talk a little bit more about municipalities, and specifically in your mind, because you're so in the weeds on this, where do you believe that municipalities are missing the mark, and how does that impact product getting to market, and then just ultimately residents that want this kind of a living style?
Well, there is a housing supply problem in this country. We've all talked about it. We've all read about it. I mentioned earlier, the president has acknowledged it. We know what the problem is. We're not building enough housing. We're not building the right kind of housing in the places where housing is most needed. To the extent that municipalities can engage more with industry to figure this out, the better off we're all going to be. We're not going to be able to get out of this by municipalities doing their own thing. And that's not a criticism of municipalities. There are some very good policymakers at the local level who are doing the Lord's work to get things done, but they can't do it on their own. At the same time, industry is not going to be able to get us to where we need to be on its own. Industry and the public sector need to come together to figure out how to move this forward. I don't believe the way to do that is by enacting heavy-handed legislation or trying to regulate the business. I think what needs to happen is industry and the public sector have to sit down around the table, roll up their sleeves, and talk about what are the best ways to build housing of all types, whether it's for sale housing, single family detached, whether it's traditional multifamily apartment buildings, or whether it's single family rental housing to include townhomes and duplexes and all that. We need an all of the above approach. We don't have enough housing, really, of any type. The answer is we need more housing, period. And again, the only way we're going to get there is to have people sit around a table, figure it out, and agree to move things forward.
Yes, absolutely. So, John, as it relates to working with local municipalities on development and even taking that product into operations, how do delays impact the operating platform?
Well, I mean, there's obviously a cost component there. Even if your materials don't change, every month that you extend is one more month of interest you got to pay on that construction loan that you're not generating income from the property to pay for. So, it's a cost as much as anything else. When you think about hiring and staffing, obviously you've got a schedule and you want to bring people on at an appropriate time. And, if you're 3 weeks late on a deal, that's not going to matter much for staffing. But if you're 6 months late on a deal, that's going to matter a lot. And it affects your marketing costs. There's nothing good about a delay. There's nothing good about it.
In terms of site selection, as you're going out and looking at deals, and this is for everybody, how does just, different municipalities and working with different municipalities kind of play into that?
It's huge. And I mean, you could think about all the markets that we're in, Atlanta, Tampa, Nashville, Charlotte, Wilmington, Savannah, Orlando. We know the counties and the local municipalities who are more reasonable and easier to deal with. And we also know the ones that are more open to our product being introduced in their market. And if we know that there's going to be a big fight, I mean, you're more likely than not just to avoid it and move on to something else. There are plenty of opportunities out there without having to deal with obstructionist municipalities.
Well, there have been several states, David, that have enacted kind of by right zoning changes. I know Florida had an issue, although I was reading in a particular area in Orlando where a BTR developer was trying to get something through entitlement and still got all neighborhood opposition and a Facebook page about themselves, even though they were just trying to live under the laws because they claimed it was a wetlands. Have you seen, that kind of situation, even with these state opportunities kind of play out?
Yeah, I've seen those sorts of things really from a distance. I mean,
Yeah.
John's on the ground; he would be able to speak to that
Yeah.
more directly. But yeah, I've certainly seen that, and a lot of that really has to do with again some of these narratives that have been out there for a while about the industry, institutions coming in, Wall Street money coming in. That we don't want that to be a part of the
Right.
community. So there's a lot of that that's unfortunately still out there, and oftentimes I think John's right. Do you want to pick a fight? Do you want to, or do you want to just try to go somewhere else where you can do some good? That's really what it comes down to, I think.
Well, we're running out of time. And so I want to thank everyone for participating and giving us a really great and fresh perspective on what's going on in DC, what's going on the ground, what's going on in the investor's mind. And we want to sell everything we can, right, Matthew? So just a couple of things that I heard from you, David, just such a great wellspring of information. I loved how you said that the standalone bill is the industry goal and not the roll up into the overall some other type of legislation. I thought that was a really key takeaway there. Of course, uncertainty is a word that we've gotten used to over the last 3 or 4 or 5 years. And so we're still living in that space. John, thanks for pointing out, the high quality materials that municipalities are concerned with and how that just creates value long term for the communities. And then, of course, we all know how everyone is being conservative on their underwrites, and we're still trying to figure out how to handle concessions, but we're watching those markets. And I'm going to leave it with my two favorite new words, which is green shoots. And I'm seeing some early signs of that. I know not in New York where it's still snowing, but I am hopeful that this is just not beginning of the year exuberance and that we see this start to really play out as in the markets, all areas that we work in over the next 12 months. So, Gregory, I'm sending it back to you.
All right. So, Kimberly, fantastic conversation. Listening to this panel, the one thing that is, clear is that we're still figuring everything out.
Yes. This has been, we started really small, and then there was just so much capital and so much excitement about the reception of the product in the market and the reception of the product among investors that we had a gold rush. 23 through 25 was just a gold rush. And so we've come down from that, everything kind of came to a halt. We're working through a pipeline, and we're kind of, we're toddlers. We're walking now, and we're learning more about the business. The guardrails are coming our way, policy risk, entitlement risk. And this is to be expected in an industry that grew so quickly out of a fragmented marketplace, and it was here to take advantage of the fragmentation. And so it's exciting to see where we're headed. Learning, as in all real estate cycles, the capital will slow and we can take time to learn. And I think that's where we sit today.
And at the end of the day, right, this is adding housing to our shortage.
Yeah, much needed different types of housing. And I think that's the point, is that, the population has shifted and preferences have changed, mobility patterns have changed. What the boomers and the Gen Xers did is really different from where the millennials have really created their own market. And then the Gen Zers are just now coming into the market in the apartment world. We're just now talking about them. They're going to double in the space in the next 5 years. And so we don't know what they want yet. They're just coming out of college. And so it's really going to change preferences. They're going to look at cities, they're going to look at suburbs, they're going to look at things a lot differently than generations before them. And I think it's a real exciting time to study and understand where the needs are in the housing market.
Fantastic. And a big opportunity, right? We're all going to be at IMN's BTR Spring Conference in Nashville in just a little over a month. And Shirley Palmer is the CEO of Taylor Morrison, will be the keynote. And we look forward to speaking with Shirley as well. And of course, we get to see you in Nashville.
Yes, I'll be there with my boots on. Good to see you.
No, fantastic. Well, thank you so much,
All right.
Kimberly Byrum, managing principal at Zonda. Thank you so much for leading this important conversation today.
Thank you. Thank you for having me.